Hey, good afternoon, everybody. Welcome into Mining Stock Daily. This is some post-market commentary. Happy to be welcomed in by the Daily Gold's Jordan Roy-Byrne. Jordan, we're going to talk a little bit of technicals because really, you're really well renowned for the technical look at gold, the metals, and the miners. So we're going to spend a little bit of time talking about the technicals, but then we're going to shift our conversation and talk a little bit more fundamentals because you and I have been thinking a lot about the fundamentals behind these moves lately. But first, as mentioned, welcome to the show and tell us it's a little bit, I don't know, it feels pretty good to feel where gold is now, but we still need like another $5 on this close to make it legit.
Yeah, I mean, we're certainly feeling better after the middle of last week, or at least in my mind, I kind of got faked out a little bit thinking, well, are we going to see that plunge and fishing line sell-off? And then it was clear at the end of last week that a short-term bottom had been made. And so I'm looking for gold. If it can close above 1750, it has a measured upside target to 1825. And there is a lot of resistance in gold around 1820 in that area. So I'm doubtful that it's going to punch through there during this rebound, at least initially. Turning to the stocks, GDX, I mean, 36, 37, you could call it 37, GDXJ, 51, 52. Those are the levels I've been looking at as far as resistance on a rebound. And that's where we're at. We have a short-term rebound. And, you know, whether this is something more, it's going to obviously more time will tell. And it'll depend on some of the fundamental things, which I know we're going to talk about.
Yeah. Speaking about the GDX, there's just the GDX. I wanted to bring your attention to get your thoughts here. Just from what I'm looking at, there's been this consistent downtrend and consolidation with the GDX from those big highs back in the summer of last year. But it tried to bust out of that trend a couple times. Once in early November, it tried to bust out and then quickly got rejected back into that downtrend. And then if you remember, literally the first couple of days of trading in 2021, January 5th and 6th, it tried to do the same thing, bust out of there. Again, rejection. And you look at the last couple of days, GDX has tried to bust out of that trend a third time. But, I think we should, could we see if it's going to be rejected here in the next day or week?
Well, I think, I'm not a huge fan of trend lines because, I think GDX, assuming it can get to 37, it's probably going to break above the trend line. But to me, that doesn't tell us, at least with my work, that doesn't tell me just because it's broken this downtrend line that it's going to rally all the way back to the high. So I think you have to be careful with trend lines and technical analysis. It's not my favorite tool, but I know when we're correcting and we're in downtrends, it makes sense for people to watch. But there's some other things that I would look at, like, getting in. Some of these things are more, they have to do with fundamentals. And I really enjoy when I can put on a chart a relationship, but it kind of expresses a certain fundamental aspect of the sector. But one thing that's not a fundamental thing is the GDX advanced decline line. That's a technical indicator. Now, that hasn't been that strong coming out of this bottom, but we'll see. I mean, if GDX rallies to 36, 37 and the advanced decline line starts gaining a lot of strength at the end of that move, that could be a positive sign. And it's only one indicator because there have been a couple times in the past it has faked me out. But that's one thing to watch. Another thing you've touched on, GDX has been outperforming the gold price, and so that's great. That's also a leading indicator that I look at. If you look at the Dow Jones U.S. Gold Mining Index, which I believe is heavily weighted in Newmont, Barrick, and Franco-Nevada, I haven't looked at it today since earlier this morning, but that's been even stronger than GDX. So, that is a good, healthy sign that, the big money, because obviously when they're going to buy the sector, they're going to buy the senior companies. So that's a good sign. And yeah, that it confirms that we've had a short-term bottom. But again, it leads to the question, where is this going a couple months, 3, 4, 5 months?
Yeah. Okay, so we're going to transition into fundamentals, but in a casual transition, I am going to kind of punt the fundamental question off a back of a technical question, and that's looking at the DXY chart, we have came down today below Dixie's 200-day moving average. I know some people were just seeing if it would test that, if it would get a bounce. Today, obviously, no bounce off that 200-day moving average. Is this one of those fundamental things you're looking at as you continue to see where the gold price might head into?
Well, more than the dollar, one thing I like to look at is how is gold performing against foreign currencies, and that's another way to look at that is uh, it's equivalent to gold multiplied by the dollar index. And that, going back over the last 20 years or so, most of the time that has been a really good leading indicator. And over the last, I want to say, week or two, that was showing a little bit more strength than the gold price in dollars. I mean, as at least in the last week or two, gold was was trying to bottom, even though the dollar was going up. So that's where gold was showing some relative strength. And so my attitude on the dollar is fundamentally, I think silver tends to be more linked to dollar weakness than gold.
Mm.
I mean, looking at the dollar, I mean, it has turned down in the last couple days, but I'm skeptical that we're going to see a huge leg down. I mean, this could be a correction leg for the dollar, and then maybe it has another push higher in this larger counter trend move. I think stepping back, looking at the dollar, the next big move in the dollar is probably going to be at the end of this rally, whenever it rolls over and it's threatening to break below that 88, 89 level. That's going to be a major, major breakdown. But I see at least gold and maybe silver. They're going to lead that breakdown in the dollar. So to me, the
Mm-hmm.
dollar, to me, I look at it's kind of a lagging indicator to me. So I mean, if I'm right and the dollar still has more upside over the next couple months, then I'm looking at how is gold performing against foreign currencies. Because if gold really shows a lot more strength there, then that's telling you the dollar is not going to have that much more upside, or that it's really not impacting gold. So I know that wasn't a direct answer,
Yeah, no, it was
but
interesting. Yeah.
if I had to guess one way or another, I think the dollar is still has a shot to move higher from here. But that's
Yeah.
just a guess at this point.
Yeah, it's like that was the double or triple rainbow. What does it all mean? Type of situation. uh, okay, so let's talk about fundamentals. I know you have been looking at some of the fundamental reasons behind gold, as I have. We haven't talked about what those reasons are, Jordan. So I'm wondering if there's any, if our ideas kind of cross paths here. So lay down your thesis here and what you're looking at.
Well, my thesis right now, and stepping back for a second, I mean, we know that gold it's a declining or negative real rate story, which means for gold to go up, you either need aggressive Fed rate cuts or you need accelerating inflation. Now, in the last 8 or 9 months or so, or 6 months or whatever, you could say, yeah, well, the market's pricing in higher inflation. But the issue with that is recall that gold money was going into gold not because of inflation, but because of not because of inflation and economic recovery, but because of the opposite. And then, aggressive Fed action, zero rates, et cetera. So capital was pouring into gold because of that, not because of rising inflation. So there's a transition that's taking place. And because the market was moving more towards recovery, inflation, reflation, that was better for the other commodities. And when you and during higher inflation expectations period, silver outperforms gold. So silver, at least during this correction, has been doing better than gold. And the reason why gold has continued to correct is because the market, there's a lot of nuance here, so I apologize for that, but the market
Mhm.
does not think inflation is going to get out of control yet, or at least not this year. The government or the market does not think the Fed is going to do yield curve control this year, because if those answers were different, gold would have had a much more bullish correction. It'd be trading closer to its highs now than having one of the most severe corrections in a bull market that we've seen forever, basically. But with all that said, if we're transitioning to a period of higher inflation, and we're seeing some of the news I think in the last couple of days has been stronger than expected. So people are wondering, okay, well, why is gold kind of holding up well? I mean, it's inching up a little bit. and this is really important. I've looked at this in the last week and I've come to this realization. If you look back, gold has put in historically a lot of significant bottoms when the Fed has started hiking rates. It's you can go back and look at the times when the Fed has started hiking rates. And it makes sense because if you fast forward to today, if we need accelerating inflation, higher inflation expectations, if we need that to continue to go to another level for gold and silver to make this next move higher and sustain it, um, what will be the signal of that? It will be the Fed doing its first rate hike, and the reason is because the Fed is only going to hike rates if inflation is really running, and it's I don't say out of control. Let's just say it's running, it's accelerating. It gets to 3%, maybe statistically 3.5%, whatever. Then at that point, the Fed, they can hike, they can do 25 or hike 50, 75, whatever. It's not really going to matter. They're way behind the curve. So to me, I think that the next major catalyst for when gold could blast off will be around the time the Fed does its first rate hike. And if you look at least last week, I was looking, the market now expects the Fed to do its first rate hike next year. And so that is something to keep in mind if the data, if the economic data it continues to be stronger than expected. That's why gold could hold up okay, because then the market would be sniffing out, hold on, this means inflation is going to start to take off, and that's better for gold and silver, even if the Fed just does, they start hiking rates, because it's
Mm-hmm.
just a signal that inflation is taking off. It's not a signal of tighter policy. And that's why historically, the Fed has always been behind the curve, except during 1979 to 1981 or 82. Other than that time hiking rates, every other time they've been behind the curve and behind inflation. So that over the next 12 to 18 months, that's going to be an incredibly important signal for when the market could really accelerate. And who knows, if the data is really strong, maybe they'll hike early next year or middle of next year. So that's an important thing. And then on top of that, one more thing. I'm sorry to belabor the point,
Hell, you're good.
but gold against the stock market. I mean, that's the most important chart everybody should be looking at, because every big bull market in precious metals, gold has outperformed the stock market. Now, it really hasn't over the last 4 or 5 years, which is really interesting how gold has been able to climb back up, make a new all-time high. And of course, now it's correcting, but the gold to S&P 500 ratio is still in a big bottoming formation over the last 7 years. It has not broken out. So ultimately, when we see the next big move in this sector, it will happen when gold is outperforming the stock market again. So short term and long term, that is a key thing to watch.
Well, and what is something that fundamentally could make the overall stock market, like the S&P, move downward? That would be a change in yield, in interest rates. But I want to go back to this your idea about a rate hike, because I think right now the market, last I saw, was maybe placing a December 2022 rate hike. We'll see what transpires. It seems on a globally, there's no central bank that is even considering any sort of rate hike. It seems like we have this overall consensus. Every country is going to continue this easy, cheap money policy. I guess have you given some thought? Would we see in your thesis? Could we see a rate hike before we even and maybe see yield curve control from the banks because the bonds just continue to sell off in higher yields?
That's a really good point. I mean, they could do, um, it would make sense that they would do yield curve control first. So who knows? Maybe you would get yield. I mean, I haven't researched it enough to say, but my guess would be, because if you look at the 1940s, which is a good analog, they were doing yield curve control for a while, and I think 1947, when inflation really took off, that's when they allowed the Fed to do the first hike after a while. But the yield curve control was going on before that. So yield curve control is more of a function of longer term rates. But I think your question is it's an important one. It's something I need to think more about. But that would be because I did think about, well, I have this great take on, we hear about hot takes with sports and everything. But yeah, this is my hot take, is that the first rate hike, I mean, that's going to be extremely important for precious metals. But when I was thinking about that, I thought, I wonder what that means for yield curve control. And now that you asked, great question again. I would guess that yield curve control probably comes first, and that could also be. I mean, that would also obviously be a signal, but the market would sniff that out. And so, if you look at the 70s when the Fed started their hikes, gold actually bottomed before um, before they did the hike. So I mean, if the Fed, let's
Yeah.
just say, if the Fed, if June of next year is the first hike that they do, that doesn't mean that gold is going to do nothing for 12 months. It just means that this is a signal where the market could really accelerate, right before that point or around that point or a little bit after. But yield curve control is also going to be an important catalyst, and so that has more to do with longer term rates. So we'd have to watch what's going on with like the 10-year yield, the 30-year yield. That yield curve control revolves more around those yields, whereas as far as the Fed funds rate, that's the 2-year yield. Watch that. So if we see the 2-year yield start to inch higher, that's probably going to lead Fed policy. So that's also another. I mean, that could also be a leading signal as far as a
Yeah.
potential rate. So I know I'm just throwing around a lot of thoughts here, but I hope you got something out of that.
Well, let me throw a left, a curveball at you here, Jordan. And this is something where I'm interested to see if any continued fallout on the massively over leveraged, prime broker banks and hedge funds that we saw the liquidation from Archegos um, a week and a half ago. That news continues to trickle out. It's not being spoken about out loud enough, in my opinion. But we have all this easy money, over leveraged hedge funds. We've seen one big fund get basically liquidated. The fallout could continue. And I'm not, waving a red flag over here, but I'm over here about ready to like at least let it be known that this may not be over. And you think about to the global financial crisis, 2007, how things started trickling down before they started really heading downwards real quick. I'm almost wondering if those events, because of the over leverage, because of banks' willingness to just provide cash to these hedge funds and problems getting margin called on something very large, continues, if gold doesn't continue to be that protection trade, that hedge against complete chaos in the financial system. So that's a micro event I'm watching. Have you given any thought to some of that?
I was thinking about that a couple months ago, but stopped thinking about it. I don't know why the reason, but yeah, it's so hard to quantify what the impact of that would be and kind of what to watch that could be a leading indicator. I will say this: gold and precious metals are in a much better spot right now in that type of event because they have corrected for what 7 or 8 months while everything else has gone up. So I really like where they're sitting in that there's all this concern that, well, we're going to have, what if the market crashes and there's deflation, gold and gold stocks are going to get taken down. No, I vehemently disagree with that right now because they've been trending in the other direction for 7, 8 months. So they're in a bet, people, the last quarter, I mean, we saw massive outflows out of precious metals. And that's one reason to be skeptical that the market is going to, blast off here to another new high in the next 3 to 6 months. It's just not going to happen because too much money came out and it's going to take time for the market to repair itself technically. But just circling back to what I said, precious metals are in a better position to capitalize on that than they usually are because where has money been flowing since last summer? So going into stocks, emerging markets, anti-dollar trades, other commodities, U.S. stock market. It's been going out of bonds, going out of gold. It's been going into crypto. So
high risk stuff.
yeah,
That's
I mean,
the
if
high
there's
risk
a
stuff.
blow up, well, who knows? With the luck that we have in precious metals, it'll probably be a big fund that blows up, and they had a big position in junior miners
Yeah, yeah.
or gold or silver. Maybe that
Well,
that that could be the worst case scenario.
yeah. Sorry to interrupt. It just came to my attention. It literally was just this afternoon. There was a headline on Bloomberg about SoftBank losing. I think it was like $500 billion or something in this Archegos deal. SoftBank was also involved in the Reddit, Robinhood, Melvin Capital debacle a couple weeks ago or a month ago, whenever that was. And if go way back, and by way back I mean 2 years ago, SoftBank was involved in the WeWork scandal. It just seems a little iffy to me, right? And that's why I like the gold position, because there's chaos. It just seems like there's chaos.
Well, and I like that too because it's a really good I mean, the term hedge gets overused, but it is
Yeah.
a really good hedge right now for conventional investments because it's been trending in the opposite direction. If you look at historically what happens when it's trending in the opposite direction, um, before you get a bear market in U.S. stocks, then the negative correlation continues during that bear market in stocks. So this happened a couple different times in the 70s, and then also the 2000 to 2002 bear market in the U.S. So I think, I mean, to put it all together, I don't know how much more time we have left, but to put it all together, and I'm not predicting this, but this is one possibility. The economy heats up, the Fed has to hike rates. So then gold and silver, they start moving up with other things. Inflation starts overheating. It gets above 3 or 4%. Then at that point, it starts causing problems. The Fed's doing yield curve control, so that's reinforcing the inflationary concerns and problems. But at that point, the capital stops going into stock market and those types of things, and it's more going into gold and silver. And then you see gold and silver, really blast off, and then you get an inflationary bear market in the U.S. over the next, 2, 3, 4 years, and that scenario is how you get gold $4,000 and silver to $100 maybe. But I'm not saying that you should go buy futures contracts or bet on that. I mean, that's not how I invest. I'm just saying, that's one potential scenario of how this could play out over the next 3 years or so, give or take a little on each side.
The sun is going to rise tomorrow, folks. It's going to rise. Sorry for the gloomy conversation, Jordan. Great conversation. I appreciate you coming on. It was kind of a last minute ordeal, but I'm glad we could do it. Lots going on. If there's a key technical achievement here in the charts, we'll be sure to have you back on that day so we can talk about it. But until next time, my friend Jordan, thank you so much.
Thank you. And it's not all gloom because we're in the right sector.
Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decision.